Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the Week in Review, where I talk about current events for the everyday investor and home buyer. Our topics for this week: topic number one from One News on the 17th of July, New Zealand's largest bank cuts home loan rates as inflation dips. Hey, good news. Topic number two, New Zealand Herald on the 15th of July, housing, listings soar, Auckland, Canterbury, buck price falls. ASB expects turnaround in late 2024. More good news. Topic number three, Oneroof on the 17th of July, Tony Alexander, why the era of crazy house price rises is over. Topic number four from One News on the 16th of July, government considers rolling back home insulation standards. Topic number five from Kainga Ora on the 14th of July, new approach to tenancy management. So first up, topic number one from One News on the 17th of July, New Zealand's largest bank cuts home loan rates as inflation dips. The country's largest bank, ANZ, will lower its home loan rates following recent data indicating a dip in inflation. These changes will take effect from the 18th of July. For a 2-year fixed-term home loan, the standard rate will be reduced by 30 basis points from 7.39% to 7.09% per annum, with the special rate set at 6.49% per annum. A similar 30 basis point reduction will apply to 3-year fixed-term loans. The standard rate for a 1-year fixed-term home loan will decrease by 29 basis points from 7.74% to 7.45% per annum, with the special rate at 6.85% per annum. In addition, ANZ will lower term deposit rates by 10 to 30 basis points for terms of 6 months and longer, citing recent decreases in wholesale swap rates and the reduction in home loan rates. Grant Nucky, ANZ's personal banking managing director, noted that inflation has not been fully subdued despite a more lenient stance from the Reserve Bank and recent inflation data. He highlighted ongoing economic challenges and global market volatility due to geopolitical tensions. However, he emphasised that the drop in wholesale rates following the official cash rate announcement allows ANZ to pass savings on to customers. Nucky said that for borrowers, every dollar counts, so they hope these lower interest rates will offer some relief and support. He added that many customers, having fixed their home loan rates on shorter terms in recent years, will soon benefit from the new lower rates. This decision comes after Stats New Zealand reported that the annual inflation rate has dropped to its lowest in 3 years, with the Consumer Price Index rising only 3.3% in the 12 months leading up to the June quarter, nearing the Reserve Bank's 1 to 3% target range. Following this inflation decrease, banks now anticipate a cut in the official cash rate as early as August, which is going to be great news if that eventuates. ANZ's economists, who had initially predicted interest rate cuts starting in February next year, now foresee the first 25 basis point cut in November, with further reductions potentially bringing the rate down to 3.5%. ASB also suggested that OCR cuts could begin as early as next month, while Kiwibank remains confident that inflation will drop below 3% in the current quarter, aiming for the Reserve Bank's 2% target by 2025, indicating that rate relief is forthcoming. Over the past 2 years, the Reserve Bank has aggressively raised the official cash rate and interest rates to curb inflation and control spending in the economy. I think it's time for them to start reducing the OCR now. Topic number two from the New Zealand Herald on the 15th of July, housing, listings soar, Auckland, Canterbury buck price falls, ASB expects turnaround in late 2024. ASB economists forecast a steady housing market recovery later this year, despite a June downturn in average national prices and sales, although interestingly the median stayed the same for both of the previous last 2 months. So, we didn't get a decrease in the median values. The Real Estate Institute, the REINZ House Price Index, dropped 0.7% from the previous month, but rose just over 1% from a year ago. June house sales fell 13%, marking the weakest seasonally adjusted sales since April 2023. Auckland led this decline, with significant drops also seen in the West Coast, Gisborne, Tasman, Canterbury, and Manawatu Whanganui regions. Auckland's prices increased by 2.4% from the previous month and nearly 5% from the previous year, reaching a median of $1.05 million. Sales decreased 15% from a year ago, while national inventory levels rose 29% and listings increased 26%. Rhine's CEO, Jen Beard, noted that high interest rates, living cost pressures, and job changes are bringing some properties to market. The median days to sell rose by 1 to 48 days, reflecting decreased buyer activity and urgency. ASB economists expect inflation to continue slowing, with food prices dropping 0.3% year on year in June, the first annual decrease in nearly 6 years. The Reserve Bank is expected to cut the official cash rate, the OCR, by 25 basis points in November, with a 50-50 chance of a 50 basis point cut in 2024. Although, as mentioned earlier, there are now some bank economists that are predicting an OCR reduction as early as August this year. While a lower OCR might slightly boost the housing market, challenges like reduced migration and rising unemployment remain. Although, having said reduced migration, it's still quite high as far as long-term data suggests. ASB projects modest annual house price growth of 1% over 2024, anticipating a stronger rebound once economic growth improves and unemployment stabilises. So my thoughts on this are that we are most definitely past the bottom of the property market. Things might stay slow for a bit longer yet, so there's still plenty of opportunities to get some good deals across the line. I'm not expecting the house pricing market to boom in the short term, but house prices can change quite dramatically from month to month. So, if you're in a position where you can purchase property, it's a pretty good time to be out there house hunting. If you'd like to learn more about investing in property, join me at one of our free events called How to Succeed with Property Investing. I'll discuss strategies for successful investing from my perspective as a financial advisor and experienced property investor, and these events are available live, online, or in person. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book a free, no-obligation phone call or meeting with my husband, Paul Roberts, via our website, propertyapprentice.co.nz. Topic number 3 from Oneroof on the 17th of July, Tony Alexander, why the era of crazy house price rises is over. This analysis is provided by independent economist Tony Alexander. House prices in New Zealand have increased by over 6.5% annually since 1992, with Auckland at 7% and the rest of the country at 6.2%. However, future gains are expected to be lower due to several factors. From the early 90s through to 2020-2021, interest rates, both domestic and internationally, steadily declined to record lows, which is a trend that's unlikely to continue. For instance, the one-year fixed rate dropped from 9.9% in 1992 to around 2.2% in 2021, but it won't plummet to negative 5%. Obviously, the reduction down to 2.2% was due to COVID and the OCR being slashed to historically low levels. Regulations now allow more houses to be built on the same land, increasing potential supply despite unchanged construction costs. This is evident from Auckland's production boost after the unitary plan in 2016. Additionally, changes in greenfield residential land availability are expected to reduce land costs, as seen in Christchurch post-2011 earthquake, when increased residential zoning lowered section prices. Despite the new coalition government easing some landlord regulations, current rules and costs are higher than before, reducing property demand from some investors and easing price pressures. Moreover, the trend of converting homes to short-stay tourist rentals like Airbnb, for example, which previously decreased long-term housing availability, is not expected to repeat. Debt-to-income rules now limit investors' ability to rapidly expand property portfolios using debt, although to be fair, at the moment, the biggest restriction is on banks' test rates at about 9% interest rates across the board with all of your lending. Baby boomer investors are also expected to gradually sell properties to fund their retirements, which is a long-anticipated trend and one that I suspect that we've already seen in play over the last 12 to 24 months. These factors suggest that expecting house prices to rise as they did over the past 3 decades could be unrealistic. And this is positive news for future first home buyers who may feel disadvantaged by the current market. I also think it's positive news for investors because rents do tend to increase over time with inflation and wage increases. So that means that if house price increases slow down, then potentially we could see some higher yields return to the property market. So good all around as far as I'm concerned. While investor activity is slowing due to rising costs and developers face pressure to sell excess stock, there's still lots of opportunities. As one commentator mentioned, despite changes like the Bright Line test and tenancy rules, buying and renovating properties could offer good gains as older investors sell their often outdated holdings. For those with available capital, this could be a new way to achieve near past long-term gains. In other words, buy property that you can add value to and create your own capital growth. A good long-term strategy for investing success. Topic number 4, One News from the 16th of July. Government considers rolling back home insulation standards. Building and Construction Minister Chris Pink aims to reverse insulation standards that reportedly save new homes an estimated 40% on heating costs. The upgrades to insulation and glazing requirements introduced in May 2023 marked the first significant improvements in over a decade in New Zealand. Government experts informed Pink that the previous standards were significantly lower than those in comparable climates, such as Australia, the UK, Ireland, and the US. They noted that the public and building sector overwhelmingly supported the upgrades, which reduced heating requirements in new homes by up to 40%, with an upfront cost increase of up to 2.8%. However, Pink remained unconvinced, citing complaints from builders and developers in Tauranga and Bay of Plenty that the H1 standard added $40,000 to $50,000 to the cost of a new home and caused overheating issues. Pink has requested that the Ministry of Business, Innovation and Employment, commonly called MB, urgently investigate the cost of these changes. He stated that builders frequently express concerns about the new regulations in Clause H1 of the Building Code, alleging they add tens of thousands of dollars to home costs and cause moisture and overheating issues, which increase energy usage and counteract the intended benefits. He emphasised the importance of avoiding artificial barriers during a housing crisis when many Kiwis still live in cars and emergency accommodation. RNZ reports that there were industry discussions about less drastic changes to address builders' concerns, but the resolution of these discussions is unclear. On May 24th, MB officials informed Pink that they would begin working to reverse the H1 changes. Pink acknowledged that altering the system too much could cause uncertainty for the building sector, but he believed that reverting to a previous state would be the least disruptive option. Before the changes, 99% of public submissions during consultation supported raising insulation standards. The H1 standard had the endorsement of numerous industry bodies, including the Master and Certified Builders Associations, the Insulation Association, the Institute of Architects, and others. Brands and Becker consultants calculated the benefits, estimating a 40% reduction in heating requirements for new homes and a 23% reduction in energy needed to heat and cool larger commercial buildings. Despite initial support, MB received numerous complaints from the building sector after implementing the changes. Issues included homes being too warm, added costs of $35,000 to a 4-bedroom home, a 6 to 7% increase in building costs, and confusion among architects and designers. Some respondents criticised the changes as excessive and based on unrealistic environmentalist ideas. Pink's email to officials highlighted complaints from builders and developers in Tauranga and Bay of Plenty. He also referenced an unnamed building inspector who claimed that additional energy was needed to cool overly warm houses. A spokesperson for Pink mentioned that discussions were held to obtain these figures, and MB would conduct a formal review of H1's real-world impact. Fletcher Residential and Development CEO Steve Evans acknowledged that overheating could be an issue if homes weren't designed correctly. However, he also noted that the new insulation standards provided significant benefits by keeping out cold and dampness. RNZ has reached out to Fletcher Building for further comments. My thoughts on this is that this is a perfect example of how impossible it is to keep everybody happy. At the same time, there's always someone that feels like they're getting the short end of the stick. Topic number 5 from Kainga Ora on the 14th of July, new approach to tenancy management. Kainga Ora has developed a new strategy to manage tenancies and address disruptive behaviour more effectively. Frontline teams are now using the tools available under the Residential Tenancies Act, the RTA, more frequently and at an earlier stage, which I'm sure is great news for neighbours of problem Kainga Ora tenants. And I'm not saying that all Kainga Ora tenants are problematic. That's absolutely not true. It's a very small percentage, but the ones that are problematic can cause havoc to the neighbours. From March to May, the number of warning notices issued increased 6-fold compared to the same period last year, and the number of forced relocations doubled. There's also been a notable rise in applications for tenancy terminations, with 14 tenancies ended in the past 3 months due to disruptive behaviour or rental debt. A new tenancy management framework has been introduced to balance the responsibilities of Kainga Ora as a landlord, the tenant's duties, and the community's right to quiet enjoyment. This framework addresses issues such as rental arrears, disruptive behaviour, and pet management, with a focus on being firm but fair. To support this, a new disruptive behaviour policy is being rolled out to formalise the approach and guide frontline responses. The policy includes understanding the causes of disruptive behaviour and referring tenants to social and health services, while continuing to use notices and relocations to prompt behaviour change. An escalated approach will be applied in 2 situations: significant safety issues or persistent disruptive behaviour despite warnings, which in my opinion, fair enough. In such cases, Kainga Ora will apply to the Tenancy Tribunal to terminate the tenancy without providing the tenant with another home. Since July 1st, guidance and training have been provided to frontline teams to ensure quick responses to disruptive behaviour. Efforts are also being made to inform tenants about these changes. The focus of these changes is on serious disruptive behaviour. Common neighbourly issues like noisy cars, unkempt lawns, or frequent visitors will continue to be addressed through existing processes. This new approach is designed to deter disruptive behaviour and encourage positive changes. The majority of Kainga Ora tenants, as I mentioned earlier, are responsible and respectful. They will not be affected by these changes. Performance data on responses to disruptive behaviour will be regularly published on Kainga Ora's website starting in late July. And I think this is absolutely fair enough. If people can't follow basic rules of humanity, why does the taxpayer continue to support them to live in state houses? If they should respect the fact that this is a benefit to them, it is not an absolute right, in my opinion. If you abuse that right, you lose the right to stay in one of those properties, especially when there's so many families that are in dire situations who would potentially look after those properties much better than some of these problematic tenants. So pull your socks up, people, or face the boot. Are you eager to unlock the secrets of successful property investing? Join me, Debbie Roberts, for an exclusive free How to Succeed with Property Investing event. Whether you're a seasoned investor or just starting out, this event is your gateway to valuable insights and strategies. And as an experienced property investor and financial advisor, I'll share valuable insights and expert tips to help you on your journey. Our free events cater to all levels of property investors and first home buyers. I'll also tell you more about how we help our clients to achieve their financial goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today to secure your spot and register for our events. Alternatively, book a no obligation phone call or meeting with my husband, Paul Roberts, through our website. That's propertyapprentice.co.nz. Thanks for listening.